Analyzing the risk in your portfolio may seem like one of the more basic but valuable services that financial advisors provide for clients. And I think what's important about this conversation is about how it's evolved throughout the decades and how we can use technology today to better inform decisions regarding investment risk in portfolios. One thing I think historically that advisors have talked to clients about is, hey, based off of your age or based off of some of the things you're telling me in our conversation, we think you fit this risk category and here's how we'll invest your money. But I think there are some inherent biases that can arise by taking that approach. Advisors may be relying on their experience with other clients in order to suggest what they think is suitable for you, but not necessarily what you're going to be comfortable with. And so we've noticed in the past 5 years that, utilizing technology and specifically a tool called nitrogen, we've been able to better inform our decision making around risk. Some of the variables that we've been able to look at using technology when we sit down with clients, particularly prospective clients, is let's get a sense of exactly what your risk is in your portfolio today. A lot of people think they have an idea of what their exact risk is, but by taking a look of exactly what you're invested in and getting a sense of how those investments have performed and what the volatility is with those investments are over the long term, we can really get a specific sense of how much risk is actually in your portfolio and bring that to your attention and see if it's something that you are comfortable with or something that needs to be changed before you start a relationship with our firm. Second important thing is people seem to be more concerned about the downside risk in their portfolio than necessarily capturing the upside. And what can be helpful is looking back at history and looking through scenarios like, hey, if 2008 were to happen again, exactly the way it happened X amount of years ago, what would that look like in my portfolio? And so technology has allowed us to kind of take what clients have in terms of their investment portfolio, look back to scenarios that happened prior and give them a sense of worst case scenarios and take a look at how their portfolio would have performed during difficult market periods throughout history. I also think something that's critically important as part of this process is how are you going to review this? Is it going to be on a 6 month basis or an annual basis? And again, technology has given us a way to check in with clients more frequently on their risk and give them a sense of how much their risk has changed or really hasn't changed as the years go on and the market either does better or worse and how that affects their portfolio. So I think these are all things that you want to start thinking about when you think about how am I going to address risk in my portfolio and how is my advisor going to be able to interact with me on an ongoing basis and are they using technology to solve important questions about risk?